Hello and welcome to the 2025 Outlook from Capital Stewards. Is inflation on the rise again? According to the Federal Reserve, it might be. Will we ever have another recession? Will we have another recession in 2025? Are stocks overvalued after two really great years with lots of strong returns? Will the largest technology stocks, the Mag 7, will they just keep rolling? Or is it time for other areas of the market to play a bigger role? What about bonds? Why even bother with bonds if they have such low returns? That's what we've seen over the last couple of years. These are just a few of the questions that investors are seeking answers to as we head into 2025. And so in this episode, I'm going to share my view on where the economy and investment markets are headed as we turn the page into the new year. So welcome to this episode of the show. Merry Christmas and Happy New Year if you're listening over the last week or so of the year when we drop this. I hope you're enjoying some time with your family. Maybe you're listening to this while you're traveling or seeing your family and friends. So I hope you're enjoying whatever you're doing over the holidays as we start to think about 2025. As always, these Outlook episodes are a little bit longer than our normal show. So if you want to listen to the whole thing, which I'm sure you will, come on. But in case you're looking for something specific, you can look at the show notes and skip ahead to the specific topics that you're interested in. There's a lot of charts in this episode. So if you're listening to the podcast version, you might just think about switching over to YouTube, watching it there so you can see all the charts. Hopefully that'll help make everything that I'm saying crystal clear. So, all right, with that, let's dive into the economy and markets as we move into 2025. Let's start with what's happened so far this year. On the chart, you can see the S&P 500 stock index in the red line. It's now up more than 24% for the year, only to be outdone by gold, which is up more than 27% since January. Real estate had moved higher throughout much of the year on expectations of lower rates, but the Fed's reduced expectations for future rate cuts absolutely killed REITs in mid-December. And so you see the REIT returns falling there. So real estate was having a really good year, and then that all kind of fell apart over the last couple of weeks. Bonds are now only slightly positive for the year. The same story. They were rising for most of the year, really strong returns. Then we had the December Fed meeting, and that kind of put the kill switch on to the bond market. But this year's been really good. Most of our clients, most investors in general have had really, really strong 2024s, especially if you have lots of equity exposure. But most of our clients have long-term goals that extend far beyond, doing well in 2023 or 2024. And the most important factor in investing is choosing the right assets and sticking with them over the long term. So when we look at these next couple of charts that I always do, we try to sort of zoom out so we can make sure that we see the big picture of what's going on. You see on this first one, over the last 28 years, the S&P 500 is averaging just under 10%, 9.7% per year in returns. Stocks produce the highest returns over all the other asset classes over long periods of time. That's what we've seen throughout history. Even when you consider the recessions that happened in 2001, 2007, COVID, you would still be a happy investor in the stock market if you had invested right before any of those events. Gold returned just over 7% annually, especially with the recent run-up. Bonds just over 4%. All of that outpacing inflation, which even though inflation has been a lot stronger lately over the last almost 30 years, over the last 28 years, inflation's only running at 2.5%. When we zoom in and look at the past decade, the S&P 500 has returned more than 13% each year on average. Gold's up around 8%. Real estate has averaged 5.5%. Bonds are actually the laggard in this group, averaging only 1.4%. You can see the drawdown in bond performance as rates have risen on the other side of the pandemic. When you think about the 28-year and the 10-year history, like I kind of mentioned earlier, you'd be a really happy investor if you had invested at the peak of markets before the global financial crisis or right before COVID. It wouldn't have felt good in the short term, but you would still be a really happy investor today because returns have been so strong. So we're going to talk about the current state of the U.S. economy and markets in a minute. But investing solely based on next year or whether stocks are overpriced or in a bubble is a really bad idea. We talked in the last episode about the accuracy or lack thereof of these kinds of forecasts. Most of the Wall Street chops thought stock market returns this year would be pretty weak. Stock valuations were high coming into this year. Most folks thought there was going to be a pullback, but now the S&P 500 is 25% higher than it was at the beginning of the year. So selling your stocks based on the Wall Street forecast would have led to really bad results. Recessions and market drawdowns don't feel good. I lived through a few myself, but building a portfolio that you can stick with through the hard times is the best way to achieve long-term compound returns. So regardless of the rest of this outlook, think about your portfolio and your other assets and whether you feel comfortable owning them regardless of the environment, good or bad, going forward. And if you have concerns about, if we have a recession next year, how your portfolio is going to do, then it's probably time to seek out some advice, really look at your portfolio and say, hey, is this really the right thing for me to be in long term? Because you should be able to stick with it through good and bad times. 2025 has been a good year for most investors, especially those with large equity portfolios. However, I think going forward, returns are going to be harder to generate, in my view, because I think the economy is continuing to slow down. That's what the data tells us. Contrary, apparently, to what the Fed believes in their December meeting, apparently they think things are speeding back up. So more on the Fed in a few minutes. So let's look at some real data on why I think the economy is still slowing down. And once we have a good feel for where the economy is at, we can discuss various asset classes that we use to build investment portfolios. You can see on the first chart, the economy is moving along nicely. We're not in a recession. Real GDP is growing 2.7 to 2.8% a year. That's consistent with the economic growth that we saw before the COVID recession. You see the COVID recession in 2020, there's a big spike in GDP growth. That's the red line. That came also with a big spike in inflation, the green line. And then the Fed raised interest rates to cool everything off. And that's what we've been going through. Growth and inflation have come down meaningfully from their post-COVID highs. But the big question that markets are grappling with is why the Fed funds rate, which is still relatively high at 4.5%, hasn't brought growth and inflation down even closer to that sort of 2% target that everybody talks about. Now, when we think about keeping GDP high, the largest contributor to GDP growth is consumption in the US. That's all of us going out and buying stuff for our friends, for our family, for Christmas, and all throughout the year, right? And the US consumer tends to be really good at spending unless they lose their job. So let's look at the jobs market. This is where I see potential for problems as we move further into this cycle in 2025. You notice on the page that the jobs market is essentially in balance. That means that the number of job openings only very slightly exceeds the number of unemployed people that are looking for jobs. The number of job openings has steadily moved lower over the past couple of years. Firms, they fill their backlogs from COVID. Higher rates have constrained sort of further employment growth. So a lot of businesses are sort of muddling along. They're sort of pushing against the rapids in the economy that the Fed's generating. So growth is a little bit constrained. But until recently, the unemployment rate has been relatively flat. But now, as workers are losing their jobs, and there's not a lot of them losing their jobs, but as they're losing their jobs, it's becoming increasingly harder to find new ones. So when we look at this next chart, on the left, you can see the 3-month average non-farm payrolls. That's the green line. That's what you hear about on Jobs Friday when we talk about the jobs report. That's been moving steadily lower in 2023 and 2024. The labor force, which is the total number of people that are working or want work, that's more volatile. You can see it moving up and down a lot more. But that's also been moving lower. It's been trending lower. On the right-hand side of the page, I just subtract the additions to the labor force from the change in non-farm payrolls. So essentially, I just want to answer the single question: are we creating enough jobs every month to support the number of people that are looking for work? Anything over zero is good. Anything under zero for an extended period of time is a problem. For now, that number has remained positive. The labor market is okay, but again, the trend is lower. It's not higher. Outside of the headline stats, the duration of unemployment is moving up. Recruiting intensity is lower. The number of people that are leaving their jobs is lower. And wage growth is slowing back to where it was pre-COVID. Layoffs have been fairly well contained so far, so that's why we haven't had a major problem, but they have normalized. And so what does all that mean? I think there is slack in the labor market. It's not a lot of slack, but there is slack there. And if we have any growth in the number of layoffs from here, that's going to drive unemployment higher as those workers are not easily able to find new jobs. It's going to be a lot easier for us to move that unemployment number higher going forward than it has been over the last couple of years. Is the labor market about to fall off a proverbial cliff on its own? Probably not. But if the Fed continues to hold rates high, all of those statistics that I just mentioned are not going to magically turn around. The labor market's going to continue to do what it's been doing, which is getting weaker, getting looser. And eventually, that's going to cause consumers to spend less, which causes companies to earn less. And it kicks off that self-reinforcing cycle of lower earnings, more layoffs, which lead to lower earnings, and eventually a recession. And I think the risk of a recession from a policy error of the Fed is much higher than it has been at any point in the cycle so far. So far, I've been pretty bullish on the economy and markets as we came out of COVID. A lot of people thought we were going to have a recession. I thought that was pretty fanciful when GDP growth was like 4 or 4.5%. But I think now that growth has normalized and there's more slack in the labor market, I think there's a real chance that we see significant deterioration in the labor market as we go through next year, and that can cause growth to stall out. The other side of growth and sort of the labor market equation is inflation. That's obviously the concern for the Fed, and that's why they sort of have chosen to at least slow the pace of reducing rates, or so they say. You can see in the chart that the PCE indexes have moved significantly lower from their peaks when we look at the time since the COVID pandemic. If you look at the core number especially, you see the downward momentum, though, kind of stalling out in the fourth quarter of this year. And that's no doubt sort of what spooked the Fed in their December meeting. But I think when we look under the covers, we see an inflation environment that should continue to weaken next year. We got a 0.1% print, which it translates into less than 2% inflation on core PCE in December. The main component of the last 0.8% on core inflation, which is what would get us back to the 2% target, is housing inflation. It operates with a lag. We use owner's equivalent rent in the U.S. to measure inflation felt by homeowners. I don't know if you're in my boat or not, but my mortgage payment has not gone up over the last 3 years because I haven't refinanced my house or moved or anything like that. So my mortgage payment hasn't gone up. I'm not any worse off in my sort of housing payments. Perhaps, you could think about things like insurance and other cost of home ownership, but that's considered elsewhere in sort of the inflation. It's not part of owner's equivalent rent. It's elsewhere in the statistics. So my owner's equivalent rent has gone up because my house would be more expensive to rent today than it was a couple of years ago, but my payment has not. And so it takes some time for the government statistics to sort of bear out what's happening in the marketplace. But I think it's fair to say that the sort of real world core PCE inflation is running somewhere, it may not be all the way to 2%, but it's very close to 2%. For more evidence on that, you can look at the harmonized CPI. That's running at 2.3% over the last 12 months. That is the CPI measure, by the way, that they use in Europe, and most other developed countries around the world use this. It doesn't use owner's equivalent rent to capture housing costs. So I think it's a fair measure of what's happening sort of more in real time in the economy. So we're pretty close to 2%. So whether you believe me that inflation is running closer to 2%, or if you think it's running at 2.8%, it's certainly not accelerating. It's going the right direction. It's moving lower. Over the last few months, progress on inflation moving lower has kind of stalled out a little bit. We had a pretty big move down over the course of the year. None of these things in any data set anywhere in the history of the world just sort of move in a straight line, right? So we had a pretty big move down most of the year. We had a little bit of a stall out in the fourth quarter. I expect that move to continue lower in the first quarter of 2025. And our economists can argue about 0.1% in the inflation stats, but from an investment standpoint, I think it's going to continue to move slowly lower. And so inflation is not going to be a major concern for the economy. For their part, I'm not really sure what got into the Fed this month. Even with very slightly higher expectations for growth and lower expectations for unemployment in 2025, they now see significant inflation upside risk. Yeah, September and October, they were a little higher from an inflation perspective than we had previously. But the November PCE that we just got, like I mentioned, was 0.1, which is good for 12 months. And it sort of was as soft as the other 2 months were hot. So either the Fed needed a way to justify slowing down the pace of rate cutting, which in my view is unnecessary. No one was expecting them to cut every single meeting until they hit neutral. The market was already expecting the pace of rate cuts to slow, just perhaps not quite as slow as where they are now. Or they're attempting to price in the impact of immigration and tariff policy, which we'll talk about more in a minute. But the results of potential Trump policies are far from certain. And there's not any economist that can say with any degree of certainty that those policies are going to drive inflation materially higher, certainly in the next year, right? So I agree with Chairman Powell that the economy is currently in a quote unquote good place. But it's continuing to slow down. Again, that's the theme here, right? Inflation's moving lower. What we see in the jobs market is moving lower. It's not speeding up. I've seen no forecast for next year's GDP that's higher than this year's, not one. The expectation is for positive growth, but for slowing growth. Eventually, if the Fed does not get rates down, they will be the cause of the next recession. I think one of the major risks going into next year, like I said earlier, is that the Fed is late cutting interest rates because of the vagaries of inflation data and debating about whether we need to get from 2.5 to 2.3. And the result of that is that they drive us into a recession. The market's currently pricing in 2 rate cuts, quote unquote, so 50 basis points or half of 1% of cuts from the Fed next year. Um, I think we're going to continue to see interest rate volatility as the market sorts itself out. Over the course of 2024, the market expected 6 cuts, then no rate cuts, then 5 rate cuts. Now we know the answer we got was 4. My view next year is that we're going to get 4 rate cuts. So another 1% in total to bring the Fed funds rate down to about 3.5%. And then I think that might be close to neutral, right? I still think neutral rates closer to 3%, but it's certainly not in the force. One aspect that I think might be making it harder to judge the strength of the economy is the wealth effect. The wealth effect occurs when consumers determine their spending based on their assets instead of their income. As the stock market and home prices have gone up, consumers felt better off and they tend to spend more when that happens. That's especially true for baby boomers in retirement and sort of higher income, wealthier consumers. You can see on the chart, equity holdings have gone from 30 to $45 trillion in the last 4 years. That's a lot of money. I think there's a scenario in 2025 where unemployment could move meaningfully higher, but spending and GDP growth stay flattish as the baby boomers and higher income folks keep spending. Then the Fed's going to have a real quandary on their heads because they, in that case, they're going to have unemployment going higher, but the economy sort of still chugging along. In that case, they should lower rates to increase employment, but they might be doing that without us actually having a sort of GDP recession because higher income consumers continue to spend. We've heard that from companies, by the way, in the fourth quarter, as folks have been talking about their business and the shopping season, how that's going for the holidays. Higher income consumers doing really, really well, but the lower income consumers continue to be squeezed by higher inflation, lower wages, those kinds of things. And so we're seeing that reflected in how people are spending. That higher income consumer continuing to chug along. But at the bottom of the economy, there's some real stress, and that can eventually cause us to move into a recession. Before we move into asset classes, perhaps a word, like I promised earlier, on potential policies from the incoming Trump administration. I did a full episode on the various proposed economic policies during the campaign season earlier in the fall, so I'm not going to rehash all of that. But in short, widespread tariffs are not good economic policy. Every tariff drives up the price of some imported good, and all of the evidence shows that the end consumers end up paying for the tariff through higher prices. The challenge with forecasting policy is whether President Trump intends to place tariffs on every single imported good across the economy or every imported good from a country like China. That unquestionably would certainly raise prices in the short term. However, in the past, Trump has tended to sort of talk big and then implement much smaller tariffs as he sort of negotiates around other geostrategic kind of goals. Not all tariffs are bad, right? It's not a terrible thing to prevent a country from dumping goods at below market prices on the U.S. economy that are subsidized by a foreign government. A lot of that's what happened in China. So if tariffs are more limited and they're targeted at particular industries where there's unfair trade happening, the impact is likely to be more negligible. The impact of immigration policy is similar. If Trump really did round up 11 million illegal immigrants in this country and ship them back to where they came from, we would have immediate labor shortages, inflation, lower GDP, all kinds of problems. In reality, they're not going to do that. That would cost, I don't even know how many hundreds of billions of dollars, and no one has a plan or has presented a plan to do that, right? So I think when you hear that stuff, it's mostly just sort of clickbait in the media. I think in reality, the Trump administration will probably reduce new immigration and increase deportations marginally. That's what we saw in the last administration. So I think all of this stuff might not be as inflationary as soon as a lot of folks assume that it's going to be. So I think it's really important not to get ahead of what we know and sort of bake unlikely policy choices into the 2025 outlook. That includes members of the Fed. I also think there's a number of folks in the investment sort of economics industry, frankly, that don't like President Trump very much. And they let their opinion cloud their professional judgment. I think that's bad as well. You should sort of give equal weight to the stuff that came out of the Biden administration as you do the stuff that comes out of the Trump administration. If you're, like I said earlier, if you're definitively making a case that Trump policies are going to be inflationary at this point, I think you're over your skis, simply because there's just not enough information to judge either way what's actually going to happen. Once we actually get policy proposals that move through Congress, which, by the way, move as slow as molasses and take lots and lots of time to implement. So there's plenty of time to update your views and your investment views. Once there's real policy you can sink your teeth into, I think that's a better way to sort of approach it. I try to keep my political views out of forecasting work and make data-centric investment decisions. I think that's what our clients are asking us to do. And I think the investment industry sort of writ large would be well served to do the same. All right, I'll get off my soapbox now. So there are other economic topics we could cover, but I think inflation and the employment situation are the major parts of the risk and opportunity set as we move into 2025. So in summary, my view is that the economy is growing, but slowly, and it's decelerating in line with the slow growth that we saw before COVID. I expect that to continue next year, sort of albeit as rates move lower with an even weaker labor market. The risk to the economy is that the Fed sort of overstays its welcome on higher rates and drives the economy from slow growth into no growth or negative growth. And I think that very well could happen next year. I think the likelihood of that is much higher as we go into 2025 than it has been so far. The room for error is a lot lower. So I think it's a real risk that we have to think about as we move into 2025. Let's talk about how all of this sort of economic backdrop sets up for the stock market, bond market, real estate, a couple of other assets as we move into the new year. So I'll start with stocks because equity exposure generally forms the bulk of portfolios because that's the part that's aimed at long-term growth. When we think about portfolio construction, the main question is really how much stock exposure should we have? Equities, both public and private, provide the bulk of portfolio growth over the long term. After that important question is answered, you can fill in the rest with what we call diversification and income or diversifying assets. On the stock market, this was a banner year. If you own something close to the equity indices, you can see the S&P 500 is up really more than 25% now for the year. The growth has been highly concentrated in the Magnificent Seven, which are a few really large technology companies that are involved in the production of AI and sort of the related chipsets and cloud infrastructure that goes into making AI a reality. Think names like NVIDIA and Google, Microsoft, et cetera. The average company, though, has done okay as well. The return of the average S&P 500 company is up almost 12%, which is in line with historical averages. So it's been either a very good year or a good year across the board in the stock market. The challenge with all of that outperformance, especially from sort of the large tech stocks, is valuation. The market is currently trading about 22 times next year's earnings. The historical average is closer to 18 times. That means that investors are paying a premium to own the future earnings of all these companies. This year, the S&P 500 grew earnings about 12%. That means about half of the return can be attributed to earnings growth. And the remainder of that 25 or so percent is the expanding multiple or the increasing price that investors are willing to pay. This often gets referred to as sort of animal spirits, quote unquote, driving the market as if that's a real thing, like there's spirits out there. There are no spirits placing trades. They're just people either buying too high or too low. I prefer to find sort of real answers to what's driving the market and not just rely on the animal spirits. And then hopefully we can figure out when the animal spirits are going to stop. That doesn't sound like a really sound way to invest. In this case, it seems like the increase in the S&P 500 is sort of 50% increased earnings and about 50% optimism about the future that drove markets higher. For 2025, as we go into next year, the consensus is for another 15% earnings growth. That's roughly $275 per share for the S&P 500 index. 15% would be a fairly optimistic scenario. Analysts typically overshoot. But if that turned out to be true and earnings were $275 and the S&P 500 were priced at 22 times earnings, so where it is now, the index would be worth $6,050. That's a whole 2% more than it's worth today. It wouldn't surprise me if we closed 2024 close to that number. So that means earnings are going to have to exceed those estimates for 2025 and continue to grow in 2026 as sort of the index moves over and starts pricing 2026 for us to have some more significant stock market returns. Those same analysts expect the economy to continue to slow down next year, right? We talked about that earlier. Not having a recession, but slow down. So slower economy, more earnings. You can see sort of we got maybe a problem brewing here. You've likely heard about forecasts for modest growth over the next decade. Goldman Sachs famously put out sort of this 3% growth estimate for stocks over the long term earlier in this quarter. That's based on the high valuations that we see today. Valuation, sort of the price earnings multiple, there's other things you can use. It's a terrible market timing tool because stocks can continue to be overpriced for a long time. But valuation is the best predictor of 10-year stock market returns. So the market is overvalued by every reasonable metric. However, I like to urge a little caution for those that want to jump off the cliff and sell everything. Yes, multiples are comparable to 1999 or 2000, but I don't think we're in sort of full on bubble in the stock market yet. The reason is that the companies with those high valuations have grown earnings and cash flow tremendously over the past few years. So, like I said earlier, it's not all optimism like what we saw in the late 90s. Some of that is sort of translated into cold hard cash on the bottom line of companies' earnings and balance sheet. And the market usually doesn't just correct sort of just because. It's more likely we continue to see positive returns, albeit at a lower rate, until something comes along to change the course of the market, perhaps like a few bad unemployment prints, like I discussed earlier. So I'm having trouble making the math work for another booming year in the stock market in 2025. I think we're more likely to see lots of volatility as the economic story plays out and optimism fades. Perhaps we end the year with positive returns, but 7 to 8% feels more appropriate, something below average. Um, my view is that earnings end up growing far less than analysts expect, and the multiple on the market doesn't continue to increase, so only modest upside in the stock market from here. I think that means being very careful about big overweights to technology stocks. They're likely going to continue to lead the way from an earnings perspective, but when the growth scare sort of comes at some point later in the year, investors are going to sell what they own. We saw that back in August. And what investors own very clearly is sort of the Mag 7 tech stocks. So my view is that they carry a lot of risk going into 2025, and investors should look for a more balanced approach to their portfolio. That doesn't mean sell them all, but it does definitely mean think about what you own there. I don't think smaller companies or value will outperform with growth continuing to decelerate, but I do think the gap between technology stocks and the rest of the market will continue to narrow, and the sort of non-Mag 7 universe, the 493, so to speak, will provide a better risk return trade-off as we go into 2025. So if equities are less attractive than they have been for the last few years, what other assets can help us diversify the risk if something happens to stocks? Remember, equities, both public and private, drive most of the portfolio growth. So the purpose of the other assets is to diversify the risk of major equity declines if we see something like that. So let's start with bonds and interest rates. One major question for markets is where long-term interest rates will end up. The 10-year Treasury rate is used as a benchmark for business financing, mortgages, and lots of other things across the economy. I've used these charts in the last few outlooks, but my view is that the right answer for long-term rates is somewhere between what we saw in the strong economy of the 1990s and the very low rate experience of sort of financial repression from the financial crisis through 2019. You can see on the chart that the spread above inflation for the 10-year Treasury was about 3.6% leading up to the financial crisis. Assuming that inflation moves back close to the Fed's 2% target, which is our base case, that leaves the 10-year between 5.5% and 6%. However, I don't think all of the deflationary forces from the sort of post financial crisis era are completely dead, right? Productivity, AI, technology, all of that stuff is deflationary, right? And it's more deflationary the longer we go through history. We've already seen goods prices return to deflationary prints. That was sort of the world that we lived in the post GFC era. And during that sort of period of time, the 10-year Treasury only traded about 1.2% over core PCE. So that would leave the 10-year trading somewhere between 3.2 and 3.7%. So my view has been that the right answer for rates lies somewhere right in between those two realities, the sort of pre-financial crisis and the post-financial crisis world. And that leaves us pretty close to where we are today, a range between 4.25% and 4.75% on the 10-year. So as we move into next year, my view is that the slowing economy should drive rates back towards the lower end of that range, perhaps even back below 4%. But generally, investing is about managing risk. So I'm comfortable adding to longer-term bonds in a world where inflation is falling, the Fed is lowering interest rates, not raising them. We have a slowing economy. All of that should keep rates from rising too much from here. Even if rates don't fall much, investors can clip their coupon and earn returns from 4.5% to 5.5% without taking a whole lot of risk. My view continues to be that bond investors should own very short-term bonds in cash and then long-term bonds. You can see on the next chart that sort of intermediate term bonds suffer when we have this flattish yield curve. They don't pay as much interest as cash. They don't have the same upside if rates fall as long-term bonds. So you can think about it like a bond barbell, if you will, with cash and then longer term bonds. Returns will be in the low single digits if the economy continues to hum along, and that's okay. Because remember, the purpose of this part of your portfolio is diversification. If the economy and markets remain strong, your equity portfolio continues to drive returns. That's a really good thing. Bonds and other assets are there for the times when stocks falter. Also, remember that the bond market is broad. There's lots of things on this chart. Think about corporate bonds, high yield, international bonds as well for 2025. Spreads on investment grade and higher yield bonds are very narrow. And what that means is that the extra yield that investors earn relative to sort of the risk-free US Treasury rate, the spread that they're taking is very low. That extra yield is very low. But those spreads can, and sort of just like stocks can stay overvalued, spreads can and will remain very low unless we have a recession. So the extra yield that you get from those higher yield bonds or corporate bonds, corporate credit, can provide extra return for investors that are willing to take on a little bit more risk in their bond portfolio. It's not all about the rates and cash versus treasuries. If you can earn 5 or 6%, in sort of investment grade corporate bonds without taking on a whole lot of credit risk, that's a pretty attractive value proposition for a lot of investors that need sort of high, single digit returns to grow their portfolio over time. That means you've kind of locked in a good percent of your portfolio's total return. So what about other asset classes outside of bonds? Let's start with gold, which is coming off a really strong year in 2024. Gold should be one of the few diversifying assets if we see inflation sort of surprise us and move higher. Gold was one of the top performing asset classes in 2024. That's driven by above average central bank demand for gold and also some investor demand for gold, sort of thinking rates are going to go back down, and so we'll sell some bonds and buy gold. Going forward, if the path of future rate decreases is slower, that'll keep a lid on returns. I wouldn't expect the kind of sort of double-digit returns that we saw this year. But central bank demand across the world remains pretty strong. Central bank buying in the gold market, it's decelerated from last year by about 10%, but it's still above the averages that we saw over the past decade. Global central banks tend to buy about 500 tons of gold every single year. In 2022 and 2023, they added over 1,000 tons, so sort of 2x the long-term average. This year, they're on track to buy about 900 tons of gold, 2024, so still pretty strong. I would expect central bank demand sort of to continue. It's going to continue to put upward pressure on gold prices until they get back down to that sort of 500 tons a year average. I think gold acts as a diversifier in portfolios if inflation returns sort of unexpectedly, or if we have a recession, rates move materially lower. So I think it's a good diversifying asset to own in portfolios. Let's look at real estate, both residential and commercial, because there's lots of real estate that you can own. On the residential side, national home prices are up about 4% over the past year. That's very market dependent, okay? Some of you are like, well, my house is up more, it's up less. It's very market dependent. Some markets are closer to flat. Others are seeing sort of upward pressure on prices. Obviously, higher mortgage rates have slowed down transaction volumes as folks are sort of locked into their existing low rate mortgage. From a homeowner standpoint, I don't see mortgage rates going all the way back down to the 3-4% levels that we saw in the 2010s. I think they'll continue to drift down from today's elevated levels, perhaps back into the sort of 5% range. But that should be viewed as good from a mortgage rate perspective going forward. So if you're waiting on rates to go down, I think you need to sort of reset your mind that good looks probably like something in the 5s, not something in the 3s or 4s. Prices probably continue to go up again. So if you're in a location for an extended period of time, I think it pays off to buy a house versus waiting for sort of a better rate, lower prices, all those kinds of things. You're going to need to adjust your affordability expectations if you're in that sort of rent versus own sort of decision tree. Buy something that you can afford now. I think you're well served to own real estate as opposed to continuing to wait. For residential investors, higher rates, I think, make longer term rentals more attractive versus the short term rental market. So, Airbnb, VRBO, it got so popular with low rates in the late teens and early 20s. With rates this high, most of the deals that I see in the short term rental market don't cash flow. That means it's hard to find a property that you can buy with a high interest rate mortgage, pay for the marketing and operating cost, do all the stuff you need to do to market the property, and then break even at the end of the year. So I think sort of the focus for new money should probably be elsewhere, not in the short-term rental market. But there's still, on the residential side, there's sort of longer-term rentals that I think may be a more attractive option. Also, speaking of elsewhere, there's also commercial property. The commercial real estate market is still kind of the tale of two halves a little bit. Commercial office properties continue to struggle as demand for office space was dramatically reduced post-COVID, despite what you see in the news about return to office programs, and I continue to see a lot of it here around the holidays. Offices are operating about 54% of their occupancy levels, according to Castle Systems. That's the company that tracks those card swipes every time you go into a corporate office. The result of that is companies are reducing their space when their leases come up for renewal, and office properties are struggling as a result of that. But other parts of the real estate market, retail, industrial, multifamily, apartment housing, are doing okay. So if you're looking at default rates, they're a long way from the 2008 levels. I think default rates will rise as sort of the extended pretend party where owners extend unprofitable deals. They've been doing this for the last couple of years, hoping rates are going to go lower before their financing comes due. I think as some of those deals come up to the market in 2025 and 2026, we're going to see higher defaults because they're not going to be able to extend them yet again. But that can be attractive if you have new capital to deploy to buy those properties that are on sale. So if you can buy a newly launched fund that's buying properties valued based on today's interest rates, with today's debt levels, with today's occupancy levels, I think that might represent an attractive opportunity to buy properties in the commercial space at relatively low values. The challenge with many REITs, with real estate investment trusts, both public and private, is that they're perpetual in nature. So in addition to their ability to acquire properties at today's good values, you're also buying shares of their prior holdings, and that might drag on performance for a while. So I think there may be a buying opportunity emerging in some spaces, but I wouldn't blindly assume that all real estate funds are going to benefit equally. You need to find a fund that's raising fresh capital, that's buying at today's good prices. Also, if you can stick sort of several $100,000 into a private real estate fund, you can likely buy a small local property, both residential or commercial, on your own. You might be better off buying your own properties in your local community that you know well, than investing through a larger fund if you have the appetite to do that sort of thing. So think about sort of owning individual properties as opposed to the sort of the real estate fund world. Lastly, crypto. I get more and more questions about crypto, especially as sort of ETFs roll out, and they can be purchased sort of in standard brokerage accounts. You don't have to create a wallet on Coinbase or somewhere like that. When anyone asks about crypto or Fartcoin, by the way, $1 billion valuation now, and so yeah, clearly no froth in the market, right? If anybody asks about any of the crypto stuff, I usually ask why you want to own it. Why do you want to own crypto? And one of the questions that I asked too, sort of with that, is whether or not you trade with margin in your brokerage account today, which means do you borrow money in your brokerage account and buy stocks with it? The reason that I asked that question is because crypto is essentially a risk asset, and really it's a magnifier of risk. If you look at the chart, you see the Bitcoin prices in the red line almost do the opposite thing as inflation in the green line. They're negatively correlated. Bitcoin has a strong positive correlation with, you guessed it, the triple leveraged ETF that tracks the NASDAQ Tech Stock Index. That means that gains and losses are magnified 3 times over what you would have had ordinarily on a given day in the NASDAQ technology stocks. So if you want to own crypto, which I'm not for or against, you have to think about it like any other asset. You have to have the right strategy in mind. So crypto behaves kind of like a venture capital-esque commodity. It's not a safe haven to protect against inflation or sort of digital gold that'll be there if the world goes to hell in a handbasket. So as long as you allocate to crypto, like you allocate to venture capital, something that's really high risk, you put money in there that you can afford to lose completely, then have at it. Just keep in mind sort of what crypto is and is not. And like I said, don't expect it to be a safe haven if the world sort of comes crashing down. There's very little evidence that it will behave that way. So, all right. As usual, I try to sum up all my thinking into a few bullet points as we get towards the end. So first, my view on the economy is that we're not going into an imminent recession in the first quarter of next year, but I do think the world is weaker than many investors, including the Fed, believe. And for that reason, I expect rates to fall moderately from here, for stocks to have positive but lower returns next year than this year. That means looking at other assets in your portfolio like bonds and real estate for potential gains, and also as a risk management tool in addition to stock returns. I always recommend creating a long-term portfolio that you can stick with. So this is not a recommendation to sort of time the market and sell all of your equities, but I would consider rebalancing back to your equity target if this year's gains have made your tech exposure outsized relative to the rest of your portfolio. I would also consider buying bonds with excess cash. Rates are still very high, but my view is that sort of the risk of rates moving much higher from here is really limited. So now is the right time in the economic cycle to extend bond maturities and sort of lock in higher rates for several years. So as always, if you have questions about the outlook, if you're concerned about your personal sort of positioning or your portfolio, reach out anytime. I'm always happy to discuss how you can apply this thinking to your specific situation. And have a great new year, and we will talk to you more in 2025.